Welcome to our 2015 financial year update on the Australian office investment markets. Sporting analogies are becoming very commonplace in commercial property. Our own analogy to add into the mix is that the 2014 and 15 financial year was a year of two halves for the investment markets. The first half of the year was characterised by very high levels of activity and transaction volumes hit 8.8 billion. Over the second 6 months of the financial year, volumes fell to 6.8 billion despite the inclusion of the $2 billion acquisition of International Tower Sydney T1. Lower volumes are not a symptom of diminished investor appetite in the office sector. The hiatus in activity is largely explained by the market's focus on the investor platform. When the process concludes, it will provide an insight into pricing benchmarks and stimulate vendor motivation over the second half of 2015. JLL has already recorded significant yield compression across most office markets. In Q2, there was a tightening bias across all prime CBD office markets with the exception of Canberra. As an illustration, the tighter end of our yield range in Melbourne compressed to 5.5% and is now tighter than the previous low back in 2007. While investor strategies are wide and varied, we believe that transaction volumes over the second half of 2015 will reflect an ABA strategy. An ABA strategy implies that investors will seek A-grade locations and B-grade assets within those locations, and within B-grade locations will seek A-grade assets. Thank you for listening. If you require any further information on the office investment markets from me or any of my colleagues at JLL, please contact us.